Hey, my name is James Hookston. Welcome to my YouTube channel. Now, in this video, we're going to talk about the interest rate rises and the impact that has on property investors. So stick around to the end. And before we jump into the content, I want to ask you to help me if you can. Now, we're on a journey together and we're growing our portfolios. And what I want to do is get more eyeballs on this channel. Now, we've got 3,000 subscribers already. And I'd like to ask you to help me get to 5,000 subscribers by taking that finger of power, smashing that subscribe button and hitting the bell notification. Now, we also get 50,000 views and our target is to get to 100,000 views. How can you help with that? Very easily, smash that like button over there, guys, really quickly. Smash the like button. It will turn blue and that will let YouTube know that you want more people to see this content. Now, the market has been crazy in 2022. So 2020, 2021, we had some huge increases in property prices. Now, a lot of that was driven by the fact that people wanted to get out of the cities. They wanted more space. So places that I invest in, one that did really well, one of the biggest rises in the country was actually in Hastings in Sussex. That did really well because it's by the beach and people just wanted space because of lockdowns and stuff like that. Now, because of the pandemic, the government printed a ton of money and that was just not sustainable. And now we're at a point where that has caused record inflation. And so, or more recent times, record inflation. We've had higher in the past, but the inflation at the moment is sitting at 11%. Which is really high and isn't helping a lot of people. Now, what that normally is dealt with is by raising the interest rates above that number there in order to squash it and bring it down and put us into a deep recession. Now, this is slightly different, this inflation, because a lot of it is out of the consumer's control. It isn't us putting the prices up by spending too much, as has been in the past. Some of this is obviously from the government and the printing of all the money, and some of it is from the energy crisis because of the war in Ukraine. But it's a combination of everything that is out of the consumer's hands, really. Sometimes inflation is driven by consumers. Now, because of that, it's a slightly different scenario. What's also happening is the government themselves have a huge amount of debt. And if the Bank of England were to put the rates up to 12%, the UK government would probably default on their own payments. So it's a fine balancing act that we're trying to get through at the moment in order to bring this inflation down, but not cripple the government so they default, and also not to put us in a very, very severe recession. Now, the Bank of England says we're probably going to have the longest recession, but hopefully it's not going to be too deep, is what they're saying in their words. So, inflation's high, interest rates are rising. Now, the Bank of England base rate, we're recording this early December, is at 3%. We've got another meeting before Christmas, and it's likely that the rates will continue to rise, which is not good. So what does this mean for property investors? Well, we often, as property investors, we will be using a mortgage on an interest-only basis, right? On an interest-only basis. And so for years, since the 2008 crash, the base rate was just 0.5%, 0.5%, which was very, very cheap. Cost of borrowing money for the last 14 years has been insanely cheap. Now, it's significantly more expensive. So what would normally happen is the bank would borrow from the Bank of England at this price here, then they would put a couple of percent on themselves, and that's what we would end up paying, right? And that's what we would end up paying. Now, let's look at how this impacts us as property owners. So let's just say we had a 100 grand mortgage and the rate that we were getting was around this time 2.5%. Then we would be paying mortgage payments in a year of £2,500, and you can divide that by 12. What is that? That's around 200 quid a month, right? Something like that. It's not quite exactly right, but it's around £200 a month. And if you bought a buy to let up north, which we've got, then you were getting £600 rent. There's £400 difference there, which gives you some money to pay your tax, do your maintenance and all of that sort of stuff. And it works. And so that's been very, very easy for a number of years. Now, what would this look like in today's market? Well, in today's market, I'm looking on Money Supermarket right here. With the mortgage works, you can get a 2-year fixed deal of 4.39%. And so this amount suddenly goes up to £4,390 that we would be paying in a year. Let's just say roughly, what is that? Roughly 375, around that sort of mark. The mortgage payments have nearly doubled, and that's where we're sitting at right now. So that means that we're pretty much paying 400 quid. The rent's at 600 quid. We've only got £200 rather than £400 now. And out of that, we've got to pay taxes, maintenance. All it takes is the boiler to break, and that property has wiped out all its profit for the whole of that year. So it's quite a risky business. So what does this mean? Well, what it means as property investors is that prices are likely to keep going down. Now, we've done a video yesterday on that, and we saw that last month, Halifax are saying that properties went down 2.3%. They went down the previous month as well. And so they are starting to go down. Now, that is a sign that people are unwilling to pay what the market is saying it's worth at the moment. And that will continue to happen. Now, that mortgage there might go down to 80k in the future. Then these numbers might start stacking up at that stage, because maybe I'm terrible at maths. Let's just say the payments start going down and it's 295 that you start paying on that sort of payment at today's interest rate. Maybe that now starts working. But what will happen is either the interest rates will go down, is an option, or the prices will go down to make it so buy-to-let starts working again. It will be a magic number that the properties do work at. And that might take a period of 3 months, 6 months, 1 year. Nobody knows for sure. Now, can you keep investing in this type of market? Do properties still work? Well, single buy-to-lets, I've said this for weeks, if not months, are going to be really hard for the next 6 months. They're going to be tough because the interest rates have gone up. The rents obviously have gone up as well, but not at the same rate. There's going to be a cap on how fast those interest rates, how fast those rents can go up. They're not going to just keep going up to many, many thousands of pounds. And so vanilla buy-to-lets will struggle unless you start buying properties at below market value. So you could buy a property at an auction. And so a 100 grand house in an auction, you might get it for 70. Then you've got to put a mortgage on it and you've got to leave some money in the deal. But the mortgage might only end up being 50k, right? So 50k at today's rates, then your mortgage payments might be back at the £200. So this is what you're going to have to do to be a good investor in this market, is look for properties in different places or offer what you can afford. Make sure the numbers all stack up. People will need to sell. There'll be a certain amount of people that will sell through debt, through death, or through divorce, right? And they need to get the cash out of that property, so they will take lower offers. You can also look at adding value to the property. That's going to be a really, really important thing to do in this market, is the buy, refurbish, refinance, rent strategy. Like, we bought a property at auction for 60, spent 12 on it, got it revalued at 100, so we were able to pull money out of that deal. And that is another way that you can create some equity. You can make the property worth more, and that will allow you to pull out some of your deposit, leaving you less risk in that property. But also it will mean that you'll be able to achieve a higher rent from that property as well. Other things that you can do in this market that will really work well is things like houses of multiple occupancy, HMOs. Now, the reason they'll work quite well is certain people are going to be unemployed. Certain people just need to cut their costs at the moment. And so that market is very, very busy at the moment with people that just want a room. They want fixed price. They don't want to have to worry about the gas and electric because you sort that all out for them. And those high cash flow strategies are likely to do way better in this type of scenario. So yeah, buy-to-let vesting is more difficult. It is going to work. There will be a drop in prices for sure in that type of style of property because they're just not going to work at where they are at the moment. But let me know, what do you think? Where do you think interest rates are going to go to? The Bank of England were, well, not the Bank of England, the markets were predicting the base rate would go to 6.5. Now they're saying it will probably peak out at 4.75, which means you'll probably get some 6% deals out there. And so that's where I think it's going to start peaking at. Because we've got a 3% base rate at the moment. You can still get deals right now for 4.39. We're 1.39 above base rate. The mortgage works are doing that. They've got a load of deals on their Land Bay. Have got one at 4.89. So you're still getting just under 2% above base rate at the moment. And so if we peak out here, maybe we'll get just above 6% as a rate. Now, that's what I think is going to happen. But we'll see. If the prices keep going down really fast, then the government might step in and maybe do another stamp duty holiday, a better stamp duty holiday. They'll do something to motivate the market. Maybe the inflation will come down faster. There's indications that energy costs are going to start dropping, which is a good sign, I think. And so we'll keep an eye on that as well. Let me know your thoughts. It's really interesting to hear from you guys. Do like these videos, guys. That really, really helps to get eyeballs onto it. Subscribe and hit the bell. Comment below. Check out all the other content on the channel, including this video right here.